Picture this. You're scrolling through your share portfolio one evening, feeling pretty good about how it's grown, and you have no idea that from the 1st of July 2027, the rules on what you'll pay when you sell are changing completely. If you own shares, an ETF, an investment property, or even some crypto, this one affects you. The 50% capital gains tax discount, the rule that's quietly shaped how Australians invest for decades, is being scrapped, and a new minimum 30% tax on your gains takes its place. Stay with me, because I'm going to show you exactly what it costs and what you can do about it. Now, if you've never had to think about capital gains tax in detail, that's completely normal. It's one of those things that only becomes real the moment you sell something. This change comes from the 2026-27 federal budget, and the scale is enormous. The same package funds a $250 working Australians tax offset for over 13 million workers, according to Treasury's budget 2026-27 papers, and part of how it's paid for is by taxing investors like you a little harder. So today I'll give you 3 simple moves. Map your gains before and after 2027. Stress test your property plans, and review any trust you use. Let's start with the one number that changes everything. 30%. From the 1st of July 2027, that's the new minimum tax on your capital gains, replacing the 50% discount with an inflation-only discount per Treasury's budget 21-26-27. But here's the part most people miss. That 30% is a floor. Even if your marginal rate is lower, your gain still gets taxed at 30%. So how much does that actually cost you? If you're on a modest gain, say $20,000, it's a few thousand. On a $100,000 gain, a worker on $90,000 could pay around $10,500 more. And if you're sitting on a really large gain, it scales up fast. Let me show you exactly how that works. So here are the 3 moves we'll walk through together. Map your gains before and after 2027. Stress test your property strategy, and review any trust you use for the new 30% floor. Each one takes under 20 minutes, and every single one is free to do yourself. Let me explain the mechanism simply, because the difference matters. Under today's rules, if you hold an asset more than 12 months, you get a 50% CGT discount, meaning only half your gain is taxed at your normal rate. From the 1st of July 2027, that flips. You'll instead be taxed on your real gain after inflation, with that 30% minimum on top per Treasury's budget 2026-27. Now, I want to be upfront with you here, because this is the honest part most explainers skip. Inflation typically only shaves a few % off your gain, so for almost everyone, the discount you're losing is far bigger than the small inflation relief you gain. That's the catch that makes this change bite. Let's put real numbers on it so you can see yourself in this. Take someone on $90,000, a marginal rate of about 34.5%, including the Medicare levy, with a $100,000 gain held 3 years. Today, half is taxed. $50,000 at 34.5%, about $17,250. From 2027, inflation strips maybe $7,500 off, leaving a real gain near $92,500. Taxed at the 30% minimum, about $27,750 on authors' estimates from budget 2026-27. That's roughly $10,500 more on the exact same gain. And here's where it gets even more important, because there's a second layer coming. Now the second layer, taxes, and it stacks right on top of the first. From the 1st of July 2027, negative gearing on residential property is limited to new builds only per Treasury's budget 21-26-27. Anything you held before 7:30 p.m. on the 12th of May 2026 is grandfathered, so it's safe. But if you buy an established property after that date, you can no longer deduct your rental losses against your salary, only against other residential property income, or carry them forward. And from the 1st of July 2028, family discretionary trusts face their own 30% minimum tax, so let's see what that actually costs in real dollars. Here's the cost. Picture someone on $120,000 with a $10,000 annual rental loss. Today, at a 39% rate, that loss cuts their tax bill by about $3,900 a year on authors' estimates from budget 2026-27. Under the new rules, on an established property bought after May 2026, that's gone. The loss can't touch your wages at all. Over 10 years, that's nearly $39,000 in lost tax relief, turning what felt like a manageable shortfall into a full cash drain you have to fund yourself. Now, there's a belief that stops a lot of people from looking into this, and if you've thought it too, you're in good company. People assume this is only for the rich. It won't affect me, they say, picturing property moguls, not someone with a few ETFs. But here's what's actually true. It applies to every CGT asset you hold: shares, ETFs, managed funds, crypto, and property, for any gain accruing from the 1st of July 2027 per Treasury's budget 2026 to 27. If you've got an investment of any size outside super, you're in scope. Let's put the two costs side by side so it's clear. Around $10,500 extra tax on a single $100,000 gain, and about $3,900 a year in lost negative gearing relief on authors' estimates from Treasury 2026-27. One hits you once when you sell, the other quietly bleeds every single year you hold. Together, they reshape what your investments are genuinely worth to you after tax, and that's exactly why mapping this out now matters. Let me make this real with one example, because numbers land better when they belong to someone. Meet Jason. He's 38, an IT project manager on a $135,000 salary. He's got $220,000 in Australian and global shares outside super, one established investment property he bought back in 2024, and a family discretionary trust he uses to stream some income to his spouse. He's 27 years from retirement, and he thought he had it all sorted. Here's what he found when he sat down and ran the numbers. Discovery 1. About $9,000. Jason plans to sell a growth share ETF in 2035, expecting a $200,000 gain. Under today's 50% discount at his 39% rate, that's about $39,000 in tax, but under the new rules, even after inflation shaves his real gain to around $160,000, that 30% minimum lands him near $48,000. On authors' estimates from Treasury 2026-27. $9,000 more on one sale, purely because the structure changed, not because he did anything wrong. Discovery 2. $4,680 a year. Gone. Jason was eyeing a second established investment property in 2027, expecting a $12,000 annual cash flow loss. He assumed his 39% rate would claw back about $4,680 a year. Under the new gearing rules, that loss can't offset his wages at all. Per budget 21-26-27, what he thought was a sustainable after-tax position becomes a full $12,000 drain every single year he holds it. Discovery 3, and this is the one that really stings. Jason streams about $20,000 of trust capital gains a year to his low-income spouse. Right now, at her roughly 19% rate, that's about $3,800 in tax. From the 1st of July 2028, with a 30% minimum on discretionary trusts, that same gain is taxed at $6,000 on authors' estimates from Treasury 2026-27. An extra $2,200 a year, and the low tax structure he was sold simply stops doing its job. Add it all up across Jason's investing life, and the gap is genuinely confronting. Roughly $95,800 in extra tax on authors' modeling from Treasury 2026-27. About $27,000 from harder share CGT, $46,800 from loss gearing relief, and $22,000 from the trust floor. Invest that gap at 5%, and the wealth he never gets to keep could top $150,000 over 20 years. Now, let's work out whether any of this is actually you. So, could this be you? Sign 1. You hold shares, ETFs, crypto, or property sitting on unrealized gains. Sign 2. You rely on negative gearing to cut your salary tax each year. Sign 3. You stream investment income through a family discretionary trust. If even one of those describes you, the next 3 moves are exactly what you need, and the good news is you can do them yourself. So where does all of this leave you? You don't need to overhaul your whole financial life. You just need a few specific practical steps you can start today. 3 moves. Let's do them. And they're all free. Move 1. Map your gains before and after 2027. Go through every CGT asset you own and work out how much growth has built up before versus after the 1st of July 2027. Log into MyGov, link the ATO if you haven't, and pull your purchase dates and cost bases from the capital gains and investment sections. That shows you which gains you might consider crystallizing under the existing 50% discount. But please, this is general information, not personal tax advice, so talk to a registered tax agent before you sell anything based on it. 3 quick steps to do it. First, log into MyGov and link the ATO if you haven't already. Second, open income tax, then capital gains and your prior returns. Third, build a simple spreadsheet listing each asset, its cost base, and your likely sale date. Good looks like a clear written list of your gains and your bring forward options laid out in front of you. Move 2, stress test your property strategy. Model any new purchases if you get zero tax offset against your salary for the losses. Use the ATO's rental properties guidance and read the rules carefully for established homes bought after the 12th of May 2026, plus the new builds only restriction from 2027. The question becomes beautifully simple. Does this property still stack up on cash flow alone, without leaning on a tax refund? Here are the steps. First, read the ATO's rental properties loss deduction guidance. Second, model your rent, interest, and costs with no wage offset at all. Third, check honestly whether you could fund 5 to 10 years of full cash losses. Good looks like a property that works standing on its own, or one that's a new build still eligible for gearing. Move 3, review any trust you use for the 30% floor. Confirm whether your discretionary trust is caught by the minimum tax from the 1st of July 2028. Then compare it against holding those assets personally or inside super, which is typically taxed at 15% in accumulation. Look up your trust on the ABR, check your deed, and read Treasury's budget fact sheets for the exceptions before you assume the old streaming benefit survives. The steps. First, look up your trust on the Australian Business Register and confirm it's discretionary. Second, read Treasury's 30% minimum trust tax fact sheet and note any exceptions. Third, model your effective rate at 30% versus holding personally or in super. Good looks like being able to clearly justify keeping the trust or having a plan to restructure it with proper advice. Why does acting now matter so much? Because 3 dates are already locked in. The 12th of May 2026 at 7:30 p.m., the grandfathering cutoff. Property held before then is safe from the gearing changes. The 1st of July 2027, the 30% CGT minimum begins and negative gearing narrows to new builds. And the 1st of July 2028, the 30% minimum tax lands on discretionary trusts, per Treasury's budget 2026-27. Here's the thing, that grandfathering date has already passed, which means every decision you make from here is made under the new regime. After you've done the work, here's how to check it's actually landed. You should be able to see a written list of exactly which gains accrue after July 2027. You should be confident any new property survives on cash flow with no wage offset, and if your trust fails the 30% test, the move is simple. Get advice well before the 1st of July 2028, not after, when your options are far smaller. Everything I've shown you comes straight from Treasury's Budget 2026-27 tax papers, the official budget tax reform pages, and the ATO. All the links are below, and I genuinely encourage you to read the source for yourself before you make any moves with your money. If you've made it this far, you now understand how the 30% CGT minimum, the gearing limits, and the trust tax reshape your after-tax return, something most investors won't realize until it's too late. The next step is simply to map your own gains this week, and if you want to go deeper, next we're tackling Division 296, the new tax on super balances over $3 million. If this gave you a clear picture of what's coming in 2027, the best thing you can do today is open MyGov and start that list of your gains. It takes 20 minutes, and it's the move everything else builds on. I'm Sophie, and I'll see you in the next one.